In this video, I'm going to discuss the constant growth and non-constant growth dividend growth models for stock prices, and I'm going to show you about using Excel for these. Now, the model, constant growth or non-constant growth dividend growth model for stocks, has some underlying assumptions. What we're going to do is we're going to use expected dividends to estimate the intrinsic value of a share of stock. In other words, if you expect a certain set of dividends to occur, then this is how much you should be willing to pay for the stock. That's what we're working at. And the fundamental assumptions here are that, one, the value of a financial asset is the present value of its expected future cash flows. That's a very basic fundamental assumption in finance for all financial assets. The only cash flows that an investor in stock receives is the dividends from it. That's what we'll assume for this. That the life of a company with publicly traded stock is infinite. So we've got cash flows that will occur for 5, 10, 20, 100, 1,000, a million years. That's a long time. And if an investor sells a share of stock sometime in the future, then the selling price is going to also be modeled with this present value of expected future cash flows. In other words, the selling price will be the expected present value of all the expected dividends as of that selling date. So if you sell the stock 10 years from now, in year 10, then the price that you get for that stock in year 10 will be the present value of the dividends in years 11, 12, 13, 14, 15 out forever and ever. So those are the fundamental assumptions here. And for our constant growth analysis first, so that'll be the first thing we look at, let's suppose that a stock has just paid a dividend of $2 per share. And so let's first off make that a little bit clear here. I'm going to use some terminology. This is common terminology in Principles of Finance. That will be called D sub 0. So dividend at time 0. This is a dividend that you, if you own the stock, you have already received. If you have not yet purchased the stock, you're not going to get this $2 a share dividend. This is the one that has just been paid. And let's assume that dividends are expected to grow at 5% forever, and that the required return on this stock, meaning the discount rate that you use for finding present values of it, the required return on this stock is 8%. And the question is, what's the intrinsic value of this stock given that information? Or in your class, or my class even, or later on in this discussion, I might very well just say, what's the price of the stock? But what we're really estimating is the value of the stock if your assumptions about what the expected future dividends are going to be are correct. So in that case, we've got a dividend that's just occurred of $2 a share. We've got expected growth of 5% a year. We have a discount rate or a required rate of return of 8% a year. So here's what your cash flows would look like if you were to buy the stock at whatever price it is that you would pay for it. You would not get the $2. That's already happened. You're not going to get that if you buy the stock now. You will get the $2.10, which is the $2 multiplied by 1 plus the growth rate. So $2.10 is 5% more than $2. You'll get that. You will get $2.22, which is the $2.10 grown up by 5%. You will get $2.31, and that would be the $2.20 multiplied by 1 plus the growth rate. And so notice that, just for ease of calculation, I've put absolute cell references around that growth rate so that I can just copy them out to the right without having to type in a new formula. And as a matter of fact, what I've done for you here is I have just listed out, I believe, 75 years worth of dividends. And so notice in year 75, $2 growing at 5% a year for 75 years, that means you're going to get a big, huge dividend in year 75. It's going to be $77 a share. That's a big dividend, especially compared to $2. But growing at 5% for 75 years leads to a pretty big number. So that's 75 years worth of them. Now, we're assuming that the dividends will continue growing forever, and so it actually, I've only done 75 years worth of it, but it would potentially, notice I've got ... here, they would potentially go out forever and ever and ever. All right, so getting back to to some calculations here. First thing, just out of curiosity, if you were to buy the stock and only get the first 10 years worth of dividends, and I don't know, the company went bankrupt or you just gave it away, or I don't know what might happen, but you only got 10 years worth of dividends, how much would that first 10 years worth of dividends be worth? And the answer is, well, it's the present value of the $2.10 and the $2.20 and the $2.31, all the way up to $3.25, $3.26, the present value of all of those, all of the ones that I've highlighted. And how would you do that calculation? Well, there's a whole bunch of different ways to do it, but the easiest way to do it is to use the NPV function, which is the way the NPV function works is that you have a discount rate. That's the very first thing that you put in it, is the discount rate, and we're taking present values at 5%. Don't make the mistake of using G as the discount rate. G is the growth rate, and growth rates and discount rates are not the same thing. So G is the growth rate in the dividends. R, the discount rate, that's the interest rate, the required rate of return that you're using for finding present values. So you put in the rate first, and then you have a range of cash flows. And in this case, let me show you how the easiest way to do this is. You have a range of cash flows, and the way that you put in a range of cash flows is you can either put them in one at a time separated by commas, and that's really a pretty hard thing to do. Or if you have a timeline, which is a bit easier, just left click on the first one and then drag your cursor over to the right, left click and drag your cursor over to the right until you get to, in this case, we only want to do it through year 10. And notice I'll go up to the formula bar up here since I've scrolled past where my formula is in the spreadsheet. You'll need a right-hand parentheses. You may have to type that in if you have not already got it. You'll typically have to type it in after you've highlighted. And when you press enter, you get the $17.19. Now let me just tell you quickly one other way of highlighting this. I'm going to delete it and do it again. Another way of doing this is if you happen to be on a laptop and you don't have an easy access to a mouse and your fingers are not particularly dexterous, you can do net present value. Again, just type it there. Type equal NPV. And then our rate again is 8%. Type in a comma, and if you don't want to use your mouse and left clicking and highlighting, what you can do, you can't see what I'm doing, so I'm going to tell you what I'm doing as I go through it. You left click on the first item. All right, now notice I've left clicked and my cursor is now free. You've left click on the first item, hold down the shift button and use the right arrow. So hold down the shift button, use your right arrow on your computer, and it will highlight this region for you one at a time. If you use the left arrow, it'll back up. If you use the up arrow, it's going to highlight up. If you use the down arrow, it's going to highlight down. But it's a whole lot easier all the while holding the shift button down. It's a whole lot easier to highlight regions this way at times, especially if you're on a laptop, because you're not having to try to do multiple fingers at once. So now, what do you do when you've got that? Now you lift up the shift button, and as a matter of fact, I'll show you back where we are. Lift up the shift button, type in the right parentheses, and press enter, and now we get the 1719. So that's just another way of highlighting that region without having to use the cursor. Now notice that's if you only held the stock for 10 years and you didn't sell it, you just threw it away or whatever. If on the other hand you held the stock for 75 years using the same NPV function, the present value of all 75 years worth of dividends, and let's go over to the end and look at that and make sure that's what we've done. The present value of all of those dividends up through year 75 is, what do we have here? $61.54. And so this stock ought to be worth, well, at least $61.54, but 6154 is only the present value of 75 years worth of dividends. There's a whole bunch more years of dividends that the company is expected to provide. So that would be year 76, 77, year 200, year 300, year 500, all of those years as well. And so we want to be able to incorporate those. Now, an infinite number of dividends would be an awful lot of dividends, especially on an Excel spreadsheet. And my Excel spreadsheet only goes out to, let's see, column XFD, and I don't know how many that is. That's a lot, but it's not infinite. It's it's a lot, but not infinite. And so, and you might ask, how did I get there? I will actually show you that too. Hit the end button on your keypad and do the right arrow. End button on your keypad and the right arrow. End button on your keypad and then the right arrow, and it will go all the way to the end. So end left, end left, end left. It gets it there as well. All right, so that's not an infinite number of them, and so we have to use a formula. This present value of an infinite stream of dividends is what's called a geometric series. And this geometric series does actually have a formula. It's the sum of the present values of all of the individual items in it. And there is a formula for that summation of an infinite number of present values. It turns out the formula for that is this. The present value of the infinite number of dividends starting with D1, discounted at the rate of return R, and growing at a growth rate of G is D1 over R minus G. Another way of writing that is, and we'll frequently do it this way as well, is if you're starting off with D0, we're not going to get D0, but we use D0 to figure out what's going to happen in year 1, 2, and 3. It's D0 times 1 plus G. This gives us D1. And then divide it by R minus G, and that gives you the summation. So we're not using R minus G as a discount rate, because remember, when you find present values, you divide by 1 plus a rate. We're actually using this as the formula for a convergent power series, if you care about that. Or alternately, this is the formula right here, or this is the formula right here, for the sum of that infinite number of present values. The present values of D1 and D2 and D3 and D4 and D5 and D500 and D1000. So how do we implement this in Excel? Well, it's pretty straightforward. We have a dividend of $2. We're not going to get that. That has already happened. D0 is water under the bridge, but it is information we have. We expect that next period's dividend will be 5% bigger than that, and they'll all grow at 5%. The required return is 8%, and the price is, right now, based on this constant growth assumption, is D1 over R minus G, or D0 times 1 plus G. This is D0 times 1 plus G, which is D1. So this part that I've just highlighted is D1 divided by R minus G. So D1, which is D0 times 1 plus G, divided by R minus G, and that gives us $70. So 10 years worth of dividends is worth 17, 75 years worth of dividends is worth $61, and all of the dividends is worth 70. So you can see why stocks are very much long-term investments. 10 years worth of cash flows isn't worth all that much in terms of the value of the stock. If you want to maximize the value of your company, you got to look at the really long term. You've got to do things that that provide value over the long haul, not just on, I say, a quarterly basis. So that would be the intrinsic value or the price of the stock. We could also do this starting from D1. Our timeline starts at D1. This is D1 right over here. We could do it starting at D1, and notice that D1 is D0 times 1 plus G. And we could use the version of the formula that says that P0 is D1 over R minus G. And we're going to get the same thing. P0, the price now, is D1, which is $2.10 divided by R minus G. And that's also 70 because we're doing the same thing. So either way, you get the same answer. Now, let's look at another situation. Suppose we expect to hold the stock for 5 years, and then we're going to sell it. So we're not going to hold it forever, not for an infinite amount of time. We're going to hold it for 5 years and then sell it. Now what happens? Well, what we've got to do is figure out what that selling price is going to be under our assumptions. Now, our assumptions are that the dividends are going to grow at 5% a year forever and ever and ever and ever. And so that assumption in year 5 is that the price at year 5 ought to be the present value of all of those dividends that are expected to happen after year 5. Now, we've actually done that calculation up here. That would be 260 and 280 and 295 and 310 and 325 all the way out forever. And so the price in year 5 is going to be the present value of the dividends in year 6 and 7 and 8. And so that I'm going to actually go ahead and put those in yellow. The price in year 5 ought to be the present value of all the dividends in year 6, 7, 8, 9, 10 forever and ever. And that can be calculated using that constant growth formula. The price in year 5 is going to be dividend in year 6, which is also the dividend in year 5 grown up by 1 period, or D5 times 1 plus G. So here's D5 times 1 plus G divided by R minus G. So this 8934, which is highlighted in yellow, is the present value of all of these dividends starting in year 6 all the way back to right at year 5. So if we buy the stock, expect to hold it for 5 years and then sell it, what's going to happen? We're going to get $2.10 for dividends. We're going to get $2.21. We're going to get $2.32. We're going to get $2.43. We're going to get $2.55. And at the same time, we're going to sell the stock at the end of year 5 after we get that $2.55 dividend for $89.34. How much is all of this worth? Well, the dividends themselves, that would be the 210, the 221 up to 255. The dividends themselves are worth $9.20. How do we know? How did I calculate that? Well, we can use the net present value function. We could have taken 210 and found the present value of it, 1 period, so divide that by 1 plus the discount rate. 221 divided by 1 plus the discount rate squared. 232 divided by 1 plus the discount rate, that's 8% cubed. 243 divided by 1 plus 8% to the 4th. And 255 divided by 1 plus 8% to the 5th. And 8934 divided by 1 plus 8% to the 5th power as well. The dividends themselves, the 210, the 221, the 232, and the 255 are worth $9.20. How is that calculated? Let's look at the formula. It's calculated using the NPV function. Net present value, and we'll go ahead and look and see how it asks for the inputs. The net present value function has the rate in it, that would be 8%, and then the values in years 1, 2, 3, 4, and 5. So the 5 dividends themselves, the present value of all of those is equal to $9.20. And notice that's a good deal less than, look there at the very bottom, calculating the sum. The sum of those dividends is $11.60. Clearly, time value of money matters. The present value of the $89.34, which itself is the present value of everything in yellow, which is everything out to the right there. The present value of everything in yellow as of year 5 is $89.34. The present value of the $89.34 as of now, as of time 0, is, well, there are a couple of different ways to do it. One of them is you can use algebra, which is 8934 divided by 1 plus 8% raised to the 5th power. Or you can use the PV function, where you have the 8% as the input for the rate. The number of periods is 5. There is no periodic payment, and if you have a lump sum of 8934, and then we have to change the sign of it because the answer is going to be a negative answer because the input is positive. And so I have to change the sign to make it positive. Either way, you get $60.80. You add them together and you get 70, which is the same 70 that we got over here using the constant growth model for dividends. And it's the same $70 that we also get. I'm going to go ahead and calculate this using the NPV function. It's also the same $70 we get if we just use the NPV function once. And let me explain how that is. The NPV function takes a string of numbers, in this case the 210, the 221, the 232, the 243, and then another final number as well, and finds the present value of each of those back to time 0 and adds them all up. Well, if we take, and I'm going to go ahead and show you how to do the calculation, equal NPV, the way you do this is you point to the discount rate, type in a comma, and now highlight up through year 4. So C40 colon F40 is the way that Excel expresses a range, and that's the range from C40 to F40. But we're not done. We need these two pieces as well, G40 and G40 and G41. We need to add those together. How do we do that? We can have a comma, type in a comma, and then take the sum of those two. Just add them together. So what do we have? In our NPV function, we have a range here. Then we have another item which is part of the range, and it has two things added together. And this will treat these two as both occurring at year 5 and discount those back to time 0. And that will also give us the $70. So it's a bunch of different ways to get $70 from the constant growth formula. Now let me make an important note here. An important note. The growth rate has to be less than the discount rate. You can't use the growth formula, the constant growth formula, if G is bigger than R. All right, so what does that mean? Well, we've got R of 8%. You cannot use this formula if G is 8% or 9% or 10% or some number bigger than or equal to R. Why is that? Well, because looking over here on the formula here, actually I can go all the way up to the top where we have a formula, D1 over R minus G, the denominator becomes 0 if R is equal to G, and of course that makes no algebraic sense. The denominator becomes negative and the whole quotient becomes negative if R is less than G, or if G is bigger than R. And the reason that makes no economic sense is because that gives you an infinite valued amount. And what does that mean? Well, what that means is that you can't have something growing at a high growth rate forever and expect it to be economically meaningful. And so let me give you a little quick example here just to see what I mean by that. Suppose that we have the size of our global annual economic output in the whole world is $100 trillion. Let's just pick a number, $100 trillion. Maybe it's 10 times that, but it's a big number, $100 trillion, say. And let's suppose that economic growth in the world, real economic growth is 3%, which is probably about right. And suppose that we're looking at a discount rate of 8%. And let's suppose we have a growth rate that's bigger than that. Suppose we have a growth rate that's, say, 9%. Well, what does it mean for there to be a really big growth rate in a stock and have that happen forever? Remember, when we're talking about a constant growth rate, we're talking about that growth rate happening forever and ever and ever and ever and ever. Well, in this case, if we allow just this one company's dividends to grow at 9% forever, when the global economy is huge and it's growing at 3% forever, well, what happens? Well, a year from now, say 1 year, we've got $103 trillion as the global economy, and we have $2 per share dividend. All right, well, all right, big deal. That's no big deal. Well, let's look at a couple years later. Suppose we look at 50 years from now. Our global economy is $400 trillion, and we're looking at a per share dividend of $1.49. Okay, that's no big deal either. Let's suppose we pick an even bigger number. Let's pick 500 years. If we pick 500 years, then we have a global economy of 100 million, billion, trillion, quadrillion, quintillion, sextillion. That's a lot. 262 sextillion. And we have a per share dividend that's pretty doggone big too, but it's less than that. But if we go out, say, I don't know, let's pick 560 years out, we actually have a company, remember this is growing at 9%, which is a lot more than 3%. We actually have a company whose annual dividend is bigger than the expected future global output. Well, that doesn't make any sense either. So this concept of a company having a growth rate of 9%, when the global economic output is growing at 3%, a company of having a growth rate that's a really big number forever and ever and ever doesn't make any sense, in the sense that that high growth rate is eventually going to make that one company bigger than all the rest of the economy in the entire world. Well, that's just plain silly. That's certainly not gonna be the case. So this is important for us to understand that we can't just willy-nilly, technical finance term, pick growth rates that are large. And in particular, when going back over here to the constant growth formula, in particular, we can't pick a growth rate that is bigger than R. Because, well, algebraically you can't divide by it, but economically it means that that high growth rate is going to give rise to an infinite valued company. So a reasonable question is what do you do if you have a company that happens to be growing rapidly? Its dividends are growing rapidly for a while, but it's growing rapidly at a rate that's bigger than, say, your cost of capital or your R. So let's look at an example. Let's suppose that we have a company whose dividends are starting off, they're expected to be $3 next year. They're going to grow pretty fast to $4 the year after that. They're still going to continue to grow pretty fast. They're going to grow $1 a year for the next 4 years. Those growth rates are all bigger than the 8% R. So let's assume they're going to grow at a pretty high growth rate for a couple of years. Well, also, let's assume that eventually what's going to happen is they will settle down to a long-term growth rate that is less than R. So let's assume that they're going to settle down to a long-term growth rate that's only 5%. So high growth rate, high growth rate, high growth rate, high growth rate, and after that, we're going to have a long-term growth rate that is less than 8% and of only 5%. So this part in yellow is the constant growth rate time. This 210 in year 4 is going to be the present value of all of those cash flows when things are growing at a constant growth rate. So let's talk about that for a second. Non-constant growth, so we've got high growth rates here in years 1 through 4, constant growth at a low growth rate in years 5 for the forever after. Well, what that means is that the horizon value, or the value of all of the cash flows in yellow, the years 5 forever and ever after that, that amount is given by the constant growth formula. The horizon value in year 4, just like we did with year 0, the horizon value in year 4 is dividend 5 divided by R minus G. What's dividend 5? That's $6 multiplied by 1.05, or 630. So 210, this D5, which is $6.30 divided by R minus G, 8% minus 5%, gives us the present value of everything in yellow. And if we want to know now the price of this company that's going to grow at a really fast growth rate for 4 years, and then after that settle down and grow at a sustainable long-term growth rate, we get, and let me give you the formula here and talk about it. We get, using the NPV function just like we did a couple of minutes ago, we get the net present value at 8% of the 3 and the 4 and the 5 and the 6, but the 6 and the 210 are at the same time. They're both in year 4. We're going to include those in the same last item on the NPV function. So the present value of the 210 and the 6, or the 216, all the way back to year 0, the 5 and the 4 and the 3. Add those all up and you get 168.94. So that's how the non-constant growth model works, is you project dividends for a while and you project them out all the way until the company is going to grow at a constant growth rate that's less than its long-term, less than its weighted average cost of capital. And suppose, I don't know, you projected it out 10 years and it's still, you're expecting it to grow pretty doggone fast. Well, project it out another 10 years. We don't have a constraint that we can't do the projections, but only 1 or 2 or 5 or 10 years. 50 years from now, if this company is growing at 25%, it's going to be doggone enormous. And it won't be growing at 25% again or 9% again. It's going to be growing at a rate that is something close to the global economic growth rate. And we've already talked about why that's got to be. Long time, a long period with high growth rate leads to companies being bigger than the whole rest of the economy as a whole.